Hello there, everyone. This is For the Common, and I am Thomas. I appreciate you tuning in, and thank you so much for ultimately the support of the channel, and I'm excited to have you with me. I think today's video is going to be a really important one. I'm not too excited about the topic. You might be able to see the wrinkles or the big dark circles under my eyes, but it's been a challenging market, and I think the key for this video is that, yes, this is going to be tough to record, and this is a little bit of an impromptu, lava lamp's not even going video, but the reason that this is so important is because it shares a critical message for investing, and I think it's a really great one to have as a baseline for us as a community going forward. So if you're new to For the Common, just a quick highlight. This is all about true long-term investing. That's the orientation of this investment approach, and there are a lot of different investment styles out there, and by all means, try them all. I did, but this is the one for me over my decade-long career in investing and investment management that really works for individual investors because you can identify great companies, you can own them for the long term, and then you can benefit from the long-term value creation and compounding of those companies. And I think that's a great way to position yourself for future financial independence as an individual. So that's the goal of For the Common, and giving you that information to have the confidence to go out there and apply hopefully some of this in your own investment career, or just watch and learn from my mistakes, because I promise there will be plenty of them over the course of the channel. So something that I talked about last time that was a highlight from my strategy video, it's For the Common Investment Strategy Part 1. There was a series of really important takeaways in my view, but one of the most important and is highlighted as Thomas takeaway number 1. So hopefully that sounds familiar, but if not, check out the video. But Thomas takeaway number 1 is that investing is a really humbling game. You have to have a lot of patience, and you have to be ready to get kicked in the shin a lot when you're an investor, because you're going to get a lot wrong over time. But that's okay. That's how you learn. And when you're a younger investor, it's great to make the mistakes now because you have a really long time to make up for them. If you're an older investor, then you're probably not going to be in the position I am anyways, so you can just learn from the mistakes, and hopefully this can be something that's good for you too in your investment story. But again, that real refocus is that investing is very, very humbling, and this is a humbling video for me, certainly, that, as you can probably tell in the title, was something that I was hoping to avoid, but hey, you got to learn and get better, and that's what this is all about. So thought it would be really important to present it to you all, and for that, I'm very excited. So before I jump in too much, I want to just outline some rules, and maybe not rules, but hopefully just things for you to keep in mind that are important to me as the one sharing this information with you. So For the Common, when I was looking at all the YouTube content out there, and some people do a really fantastic job at this, but this was something that I really wanted to pride myself in as well, is real true transparency. So something that always was in the back of my mind was that if I started a channel like this, which, hello, here we are, I wanted to show you all everything with respect to my own personal investment style and my own personal account. Now, there's some things that are certainly worrisome about sharing all that information out there about yourself, but I think for you, I really want you to remember, again, these kind of takeaways. So the reason why I'm doing this isn't to say, hooray, go me, or I'm awesome, look at what I did. And to be honest, this is definitely a video where I have my tail between my legs. So feel free to say you idiot, because I guess that's probably a better outcome. But the goal is that you can see what I'm doing, see it firsthand in this video, and then be able to hopefully grab some entertainment value, maybe some education from it, and decide what you want to do as an individual investor yourself. But the key is that, remember, just because I'm doing something as an investor, it does not mean you should do the same thing. If I own a company, don't go out and buy it just because I own it. What you need to do is do your own homework on the company and really determine if that's the appropriate investment for you. That's really key. The other thing is that my allocations as an investor, they're totally off the charts. I mean, I would probably call them jacked. I had some personal situation items that maybe caused me to go in that route, and I'll talk a little bit about that in a little bit, but ultimately, don't follow my allocation percentages. Honestly, just assume that I'm wrong on everything, and I think it will go better. If there's something that you can take away from it and do your own homework and think about your own allocations, then sure, by all means, be my guest. But I really want to highlight that again. Just because I own something, that doesn't mean you should buy it. That probably means don't buy it, actually. And then two, if I have it at a certain position size or weight, also just ignore it. Again, hopefully just trying to teach you something about investing through the lens of how I've invested as an individual. So appreciate you bearing through that with me. So as I mentioned, this video is a really important one for me. Now, again, it's not really my best day. It's not hooray me. It's definitely not that type of victory lap video. If anything, it's the contrary, because as I mentioned in the title, today was a tough day for me. I ultimately got margin called. Today is February 24th. Not sure if you followed the market today. If you didn't, good for you. If you did and were there with me, it was an interesting day. Now, I'm going to switch over to my screen and highlight a few things that ultimately happened in the stock market. But as you can see, it started off as a pretty rough day. The stock market opened down almost 3% off of news that Russia was invading Ukraine. Yeah, very sad, and I know my tone might be woe is me, but my thoughts and prayers are absolutely with the folks of Ukraine. I mean, what they're going through is an unbelievable, difficult trial and makes anything that I'm going through look like a bed of roses. So my thoughts, again, are with those people, absolutely. At the same time, it was a difficult market day, and I was already threading a line around being margin called. Now, the way margin works is that you're ultimately using the investments that you have and you're borrowing against those investments. Now, we're going to get into some pretty complex topics now, and hopefully over the course of the next several months, I'll be able to provide more information about position sizing, about using margin, and about how you want to try and implement different investment strategies in your own investment portfolio. But for now, I think this is just a very important video to get recorded now. So again, you can see that I'm an idiot, and hopefully down the road, I can be successful and be able to rebound even from really the worst case scenario as an investor, which is a margin call. So as I mentioned, I was already pretty close to the line with respect to being margin called yesterday, and we've had a very difficult series of months here in the market that's been driven by Fed concerns, the Federal Reserve, and worries about inflation that has caused areas of the market to significantly underperform. So jumping to FinViz, which is a website that I absolutely love. The ads are horrible, so I'm sorry for that. You're going to see a bunch of bad ads. But FinViz does a great job showing a lot of different things. But one of the great things they show up at the top here are the indices. So you can see we started very red and then had a really significant rally into the end of the day. And then as you can see for the NASDAQ, which is the technology heavy index, actually rallied to begin the day and then just never looked back. It was really an incredible reversal. Then we saw something somewhat similar in the S&P, but by far the winner was the NASDAQ. So something that I really love about FinViz is this heat map. So if we click here on this colorful chart, it's going to show us the S&P 500, and it's going to break down all the different constituents. So those are the companies that make up the index. And as you can see, it was a day that really benefited technology. Here in this sector, a lot of the big technology names were up as well: Google, Amazon, Tesla. But then if you look across other areas of the market, financials were hurting, healthcare was hurting, staples were hurting. Interestingly, my guess is that's driven by commodity worries, commodity inflation worries, which could happen given the fact that Ukraine and Russia are big providers of standard commodities, but as well, these companies likely have some business, especially, I would imagine Coke and Pepsi. So yeah, really interesting market day. But I think something that I want to show that kind of paints the picture of how we got here is if you look over the last 3 months, the areas that have actually been doing well and the areas that have been doing bad were opposite of what they were today. So if you look within technology, there's actually a lot more red than there was today, right? There are a lot of really big red areas, like Facebook being down 38%. That's over the last 3 months, pretty significant moves. And the areas that are doing well are energy, because energy prices are up. You've got some financials actually struggling, but some doing decent, and just overall kind of weakness for the market. So going back to today's market action, there were some really interesting takeaways that we saw. If we go to Bloomberg here, this is around the equity comeback. Let's see if I can find a highlight of oil. And oil now is at $94. That's where it ended the day. But oil at one point during the day today actually reached $100, which is a milestone that it hasn't reached. I think I heard on the news since I believe 2014, but I'll have to go back and double check that. But you can see here through the beginning of the day, it started right at that $100 level. It, before 9:30 this morning was above $100 and then slowly trickled down as sanctions were proven out that they weren't going to be impacting the oil complex within Russia. So there are a lot of really significant cross currents going on in the market right now. But the long story short was when the market opened this morning, it was not a pretty sight. And as you can see, you've got the people on CNBC here. There, he doesn't look happy, I guess. But my point is that it was a pretty scary morning this morning, and as a result, as I mentioned, I was margin called. So I'm going to switch over to my portfolio here, and I'm going to just give you a quick breakdown. So I work on Interactive Brokers, and Interactive Brokers is a great platform that I really like. There are positives and negatives, but I want to highlight a few, down the road. But this is the one that I chose to use, and as you can see, this is going to be a bit difficult to read, but my net liquidity, or the value of my account, is right around $1 million, 931,000 as of last November. And I'll find a way to show this, maybe record it in a bit, but as of last November, my portfolio was around 2 million. So it's been a rough ride. So going from 2 million, really 2.1 down to 900,000, that's a nice, $1.2 million swing. Ouch. Yeah, not fun. But that's okay. Again, investing is a long-term game, and you have to be able to write out these bumps. And that's again why I think this video can be so important, because I definitely made a mistake. I can go ahead and say I made a mistake, but I think it's important to talk about. So it was, to start the morning, right around an $800,000 portfolio. So you can see I was up about $138,000 today. I guess, yeah, good day, great day, but and was ultimately saved by that rally that happened throughout the day. But still, as I woke up this morning and checked the market, this was actually showing that it was down. My account value is down to $700,000. So why that's significant is that if I click on this details tab here, you'll see that this has changed a bit from this morning, but the initial maintenance margin, or the time where I would get margin called, was around 700,000. Last night it was around 780, and this morning when I woke up it was 700,000. I got called. So the market opened, and it was like I said, a very rough open to the market. And I was trying to watch exactly how the market dynamic would play out, see if there was a rally. And as well, I've never been called before, margin called on Interactive Brokers. So it was a new experience for me, an important one to highlight, because Interactive Brokers has a very different strategy than some brokers when it comes to margin calls. So for Interactive Brokers, I'm going to go to my trades and my orders here. So I made a lot of trades today, and I can get into the exact reason why. But what happened was that right around 9:40, I guess maybe I should say before, I was getting an alert that I had what's called negative excess liquidity. So excess liquidity is a measure that Interactive Broker uses, and they show it to you. I can go back to the portfolio tab to highlight how much space you have before you get a margin call. Right now it says 207,000. This morning it was negative 80,000. That's bad. That means you're getting a margin call. So as I was watching that unfold, and again, I've never been margin called before, I was watching Interactive Brokers and my blotter, which is this is a trade blotter. It highlights all of the trades that you've recently done. And so I was watching the blotter, and lo and behold, I saw these Tesla trades roll through, and bummer, I love Tesla. I just bought a Tesla. I'm a huge fan, and you had, what summed to be about $90,000 that got exited from Tesla on liquidations. That's what this LQD means. And Interactive Brokers has this policy that whereas some other brokers might actually call you, that's why it's called a call. They would call you and let you know that you need to add more money into your account or that you have to start selling stocks. Interactive Brokers, they don't give you that courtesy, let's call it. Instead, they just sell you out. So I got sold out of a big position that I had in Tesla that a lot of it, fortunately, has been gains. So Tesla, if you're not familiar with the stock, which I'm sure everybody is, but just so I can make sure we're on the same playing field here, has been a really incredible performing stock. And so if I go back, this is a chart on FinViz that is way back to 2013. You'll see this stock price down here trading around, the $40 to $60 level. So back in really kind of the mission of For the Common is that idea of investing in really great businesses and owning them for the long term. So that was my strategy with Tesla. And I, as an experiment, bought around $15,000 of Tesla in the 2017 timeframe at about this $60 price. It was $300 because they did a stock split. So when I bought it, it was $300, but it's the equivalent of 60. That's confusing, but let's just say I bought it at 60, and it proceeded to then fall from 60 down to about $40. So it had a pretty bad run from when I bought it down to right here in 2019 because of the Model 3 ramp, which was really difficult for the business. So, held through that. Again, that's the focus of For the Common is being able to believe in a company, have conviction, and I was rewarded for that. So that stock went from that $60 price, well, $45 actually, and just absolutely skyrocketed, right? And then if I go back to show from, let's say this is the 2020 time frame, right? The stock went from this $50 price up to $1,000. Really incredible run where that, $60 stock that I bought was up more than 15 times. I mean, just really an incredible return. I'm going to close this here. And that's, how I ended up getting such a big position in Tesla. So here you can see it here with my, top positions. Tesla is still a $99,000, $100,000 position for me, and I own 126 shares. Before today, I owned 252 shares, and it was about a $200,000 position. So you can see that $90,000 that ended up getting liquidated, which is what this says, is that I had a change in position size over the last 24 hours. So yeah, really a bummer, and a company that I absolutely loved, and now it's showing that I'm only up 200%. That's still fine. I've been buying some Tesla in the 800s, 900s, even the 1000s, because I really believe in the company for the long term, but was unfortunately forced to exit out of some of the trades that I had, the early trades that I had of Tesla. So that's the way it goes with Interactive Brokers, though. So moving on, I ended up getting that margin call, and it brought me back to zero with respect to my excess liquidity. So if the market had, instead of rallying into the afternoon today, if it had fallen, it would have been a pretty bad scenario for me, because I ultimately then would have had to have liquidated more stocks. So sitting there at 6:40 a.m. I'm on the West Coast, and trying to really understand what the trajectory of the market was going to be, I decided that it was time to reduce some leverage. And I've been holding off from doing that for a while. I shouldn't have. I'll go back to my top 10 just so you can see it, but I'm sure that I should have been selling down some of that leverage beforehand, but I held on to it for some personal reasons. Some of those were a previous job that I was in was more restrictive on what I could do with respect to my stock portfolio. Some of it was having an income 6 months ago that was going to be able to cover a lot of the debt that I was taking on. And as well, some of it was that my portfolio was doing really well. This was a $2 million account. So at the time, I took on about $2 million worth of debt, which is the max leverage that you can take on to try and hope and I guess in a belief that this concept of for the commons investment strategy would really play out over the long term. Unfortunately, that got, let's say, cut short by some of those market dynamics that I was talking about before, where technologies had a really rough several months, primarily due to the worries around Fed rate hikes. And that caused the portfolio to really suffer. And as the liquidity fell in the portfolio over time, the debt amount stays the same. So this is all about $2 million worth of debt. The debt amount stays the same. So that's ultimately how margin hurts you, is that if your whole portfolio ends up going down and you've borrowed against your assets, the thing that gets first impacted are your assets, right? So again, we can explain the concepts of margin down the road, but again, I think the highlight here is that, man, I got kicked in the shin today pretty hard, and I've been kicked in the shin pretty hard over the last several months. So going back to my portfolio, the highlight of this is that you can make mistakes as an investor and you're going to be okay. And again, this will be a little bit of an experiment, and hopefully in a few years, this will all rebound and be a $5 million portfolio. I'll call it here first. But the real important takeaway is that if you go through my portfolio, Snowflake is down 9%. Not bad. Amazon, I think I told you all in my last video, bought it 1,000. I've been buying more, so now it's saying I'm only up 51%. But there are some really incredible companies in here, in my opinion, like Trade Desk, that I'm up 1,500%. So 1,500%, which is up 16 times my original investment. That's quite amazing. So on a $5,000 investment, I've made $84,000. Really incredible. And that's the power for the common that I'm trying to unlock for you all. And that's what I had with Tesla. I had good performance before this recent downturn in CrowdStrike, some other new companies here. But I want to go down and highlight as I kind of work my way down, and happy to share this down the road and exactly how I'm positioned. There are absolutely companies that have been really, really struggles. So let's take UiPath, for example. Really great, in my opinion. Robotic process automation company is down 45%. Another company that's down quite substantially, I can go way, way down, is Teladoc. I've owned Teladoc for a long period of time, got it through the Livongo acquisition where they bought a company, and I got Teladoc shares as a result. I'm down 58%. That's not very fun. I'm down 77 in a company called Fastly, 72 in a new company that I believe in, called Amplitude. And so there are a lot of missteps in here, absolutely. But I think something that's really interesting to look at is if you look at this last position here, these are all zeroed out because I sold them today. Google, right? This is a position that my wife had a financial advisor. The financial advisor did a really great job in buying one Google share. As you can see, the price here was $260. And this was, I believe, in 2012. And that now, it is a $2,600 stock. That's been a stock that's gone up 900%. Pretty awesome, right? And that's the key of For the Common, and having some of these companies in here that really show you that power of true long-term compounding, I think is really impressive, and that gives me a lot of confidence that despite I've been struggling quite a bit in my personal portfolio here, I really believe that this is going to rebound and do substantially well. So looking across as I scroll through quickly, I think the other thing that I want to talk about is just how I managed being margin called. And I, like I said, went into this recent downturn with a particularly levered position. And can talk about it, but it's really something that I would not recommend. I, wouldn't even recommend myself to do, but as an experiment and probably being greedy and as, a way to figure out where the line is, I really tried to play aggressively. And because of that, ultimately I got liquidated on Tesla today, like I mentioned. Now, I have in my portfolio construction philosophy on how I kind of put all the stocks together, I have different buckets in my mind. So some of those, if I go back to my portfolio, are really high growth companies that have amazing potential, in my opinion, like Snowflake. There are companies that are more stable and it's still, growing, but maybe not to the same degree as some more aggressive growth companies. So that could be a company like Salesforce. Maybe you'd consider Amazon in that. And then there are also some companies that I would consider as really great quality compounding companies. So those are companies like Thermo Fisher, medical device company. You have Costco. Everybody loves Costco. You love a great deal. Or a company like Disney, right? Amazing brand and really incredible streaming service. And for me, that's a great quality compounding business. So when I was looking across my portfolio and where I had the most, say, underperformance over the last several months, it's really been concentrated in this area of technology. So when I was looking at areas that I needed to reduce exposure, the first place that I went was some of the companies that had held up better. So if I go down to the bottom here, it'll show a few that I exited, and two of which that I exited was Diageo, a really amazing business, which I'm sorry to see go in my portfolio, but as a defensive stock, a more defensive stock, was one that I ended up exiting and was about a $27,000, $28,000 position for me. And then as well, I sold a position in Raytheon. So Raytheon is a great defense company, something that, maybe for good or for bad, when there are war conflicts, defense companies tend to perform well, and there's multiple reasons for that, but one of it is that there will probably be more government spending to support the effort, and Raytheon would be a direct beneficiary of government spending. So Raytheon performed decently today, and so I decided to exit it at a modest gain. Same in Diageo, I had maybe a 50-60% gain. So decent, companies to be able to release some, let's say, a liquidity and relieve some of the pressure in case the market turned lower. And then as I went through my portfolio too, I tried to determine if there were some companies that I still had a lot of conviction in, but just had too big of a position size. So one of the great examples of that is Snowflake. I really love this company. I love Frank Slootman. He's a great CEO. I hope to talk more about the company in the future. But Snowflake here was, for me, and now it's $173,000, which before it was a $200,000 position. So it was a big position for me, my largest, especially after Tesla got blown out today by Interactive Brokers. So at 200,000, it seemed prudent that I should take some of that off the table to bring it back in line. And I sold it at a bit of a loss, and I still have the utmost confidence in Snowflake, but just thought, given my liquidity or my leverage levels, that I should take some Snowflake off the table. In addition, I can kind of go through the list this way. I decided to remove a little bit of Boeing. So I really love Boeing. It was an $84,000 position for me, so higher than some of these other really great quality compounding businesses. And the thing that makes me nervous about Boeing is that there is more cyclicality in the airlines business, specifically given their exposure to commercial airlines. So they do have a good defense business, but commercial's a little worrisome. And so just given the exposure that I had and the need for liquidity, I decided to take a little bit of Boeing down and about 12,000, and is at a little bit of a loss. So something that I decided to do. I left all my other quality compounders that I have a little higher conviction in, Thermo Fisher, Costco, Disney, S&P Global, higher than Boeing, and I felt really comfortable about that. And then scrolling down, some other changes that I made were in some of my other quality compounding businesses, and I just decided to take a little off the table for all of them. So Visa, I believed in for a long time, had a good position in it. I was up at one point, up over, well over 100% in my Visa position, having bought in it originally in the 80s. $80 stock price range, but I've decided to trim it over time, primarily because I'm worried about competition. There's a lot going on with crypto and Venmo and Cash App and all of that that's making me slightly more worried about the Visa's competitive position. So I decided to trim that modestly, and I've brought that down quite substantially over time. As well, I trimmed Accenture. I really like Accenture. I think it's a great business, but decided to bring that one down. It's a consulting business. I also brought down Zoetis, which is a animal healthcare business. Really, this theme of humanization of pets. So, probably give your pet better healthcare than you give yourself healthcare. At least that happened. That's the instance for a lot of people in the population out there. So Zoetis has been a really great company of mine. Sold that at a modest gain. I think that was higher when I sold it. Must have sold some of my early tax lots. And then also trimmed my position in Union Pacific. So that had performed decently. I was 54%, and it's a railroad and very cyclically oriented. So with all this worry about gas prices going higher and the potential for possibly a recession, seemed like one that, I really love the business. I want to keep it around, but decided to trim it. And then also trimmed a position in Smartsheets, which is a technology-oriented company. For me, it was just a little big from where I wanted it. Now, if you go through and look, talking about my mistakes as an investor, Peloton, I'm actually down 81%. You talk about margin calls, you talk about being down 100% in a stock. I'm down 81%. So I was the dummy who bought Peloton at $148, and thinking of the long-term view of the platform and their technology and competitive advantage. And, it's one of those companies. This is I think a great learning lesson of, we'll see what happens. I'm optimistic that this company could rebound over the long term. Could it get back to $148? I think it could. It's going to take many, many years, and they just got a new CEO in that seems very capable. But a great example of looking at somebody and being like, you've made every stock investing mistake in the book, and I absolutely have. But that's how you learn, and you can still do pretty well. And I think in this account, it's my only account. I'm up 250,000. Unfortunately, that was almost $1.5 million, a couple months ago in November. And again, I can show that in a little bit. I can end the video with that, but. Just a couple other trades, just for, I guess, maybe my own memory. I talked about Visa, I talked about Union Pacific. I did exit a position that I had in Danaher, where I bought in the 80s, an interesting business focused on medical devices, but I just really like Thermo Fisher. I have more confidence in that. I sold a very small position under $1,000 in PagSeguro that was kind of, I inherited it and didn't really have a place for it. I sold a position in Manhattan Associates, which is a really interesting company focused on supply chain, but ultimately a company that, again, wasn't really growing as fast as I wanted for a more growth-oriented, allocation. And then I talked about all of my other trades. So just going back quickly to my overall portfolio, it'll be really interesting to see what happens over the next couple of weeks with this market volatility. Again, I got myself some space by reducing my margin. I had 2.2 million in margin. Now I'm down to 1.9 million. My initial maintenance margin line is at 700,000, give or take. That number will come down as my portfolio value comes down. So my guess is around 700,000. We'll see if I can escape another margin call. But for me, for this specific instance of being margin called, it was looking through where I had conviction and where there were some opportunities to reduce sizes in companies that I thought are going to do well, or I really still believe in, but I just feel like I can do better elsewhere, or I have the exposure elsewhere. So for Snowflake, maybe a little bit of a rare example, and same with Tesla, because those were somewhat forced. Tesla was, and I reduced Snowflake in line just given that Tesla was reduced. I've been buying too much Snowflake. But let's take Boeing, for example. I've been buying a fair amount of Airbnb relatively recently. You can see I'm down 7%. And that's a great position that kind of counters is like a reopen trade, just like Boeing. So I felt comfortable reducing Boeing a little bit. I talked Visa. I've recently been buying some more Square. So Square's up after market, after earnings today. So that's great to see. Originally bought Square at $39. So that's been a great stock for me, and just recently bought a lot. So that's why this only shows 20, but a great company that I think is taking a lot of share from Visa. So that's why I sold Visa. And that was it. Again, looking through these and looking at companies where I thought that it either held up well, like Raytheon, like Diageo, or companies that I thought, were still good businesses, but I just wanted to make sure that I wouldn't get sold out of a company that I have a lot more conviction in, like Tesla. So just being a little bit more proactive on my trims to make sure that I ultimately can survive any sort of future market volatility. So jumping back really quick, I talked about my portfolio over the course of time, and I want to show it this way. There's a bit of information here that I just want to keep a little bit more sensitive, but so you can see my portfolio over the course of time going back into 2021 was about this 1.2, at the low here in this technology sell-off that happened in 2021. And this was the rise that I mentioned up to about 2.1 million. I mean, really an incredible run from, where probably $500,000, which was my account value. And then there you go, the whole long drop driven predominantly by the challenge in technologies. So yeah, brutal run for my personal portfolio. Just absolutely been a challenge. I think the lava lamp's going too now, which is great. But it's been a tough road, and especially going from 2.1 million down to getting margin called, it would make you want to throw in the towel and call it a day. And that's where I'm drawing the line and saying that investing, again, as Thomas takeaway number 1 highlights, that it's a very humbling journey. It's not easy to be an investor, and that's why there's so many great rewards to good long-term investors that focus on quality businesses and participate in that compounding. So I deeply believe, even though I've gone from 2.1 million down, lost more than 50%, down to 930,000 now, to being margin called this morning at 700,000, I really believe that I'll be able to bounce back given a commitment to a sound strategy. And that's hopefully what this video will be able to prove down the road. And my message to you as an investor is that if you're in a place where you have stocks down 80%, you don't know what to do, don't worry. Me too. I have stocks down 80%. I know the feeling. Or if you have out of the money call options that are expiring, worthless, don't worry. I've been there too. I know the pain. That's been a part of my learning process. Or if you're being margin called, I know, I get it. It feels like the end of the world, but my friends, it is not the end of the world. And if you can, again, commit to a sound investment strategy, and deeply, I believe, if you can participate in companies and that excellent long-term compounding potential and not get scared out because of the market environment or not have to sell because of margin calls, you're going to be just fine. So, and if you don't believe me, that's a-okay. And some of it's an experiment. So For the Common's going to be there to hopefully, and like I said, a year or two, we can look back on this video and laugh, A, at my terrible lighting and bad background, but also, B, that we've made a lot of money over the course of time, and we've been successful investors. So thanks again for hanging on. I appreciate you tuning in, and hopefully the next video will kind of wrap up some of those strategy points, explain some of the items that I talked about in the video concerning my personal portfolio, and I hope you tune into that. Thanks again.